Now, for more on how to survive these manic markets, we are joined by two top money minds. We have Dennis Hynes. He's the chief market strategist at RW Pressprich. He's also a black belt in karate, so you got to be careful. Also, we have Michael Purves. He is the chief market strategist at BGC Financial. Gentlemen, good to have you with us. I'm going to start with you, Michael, and explain to me if this whole idea of panic selling is something to be avoided. I got to think that professionals know this. So who are the people that are selling on days like today? I can't believe, is it really that the retail investor, is calling up the broker or going online and clicking the sell button? Is that what drives the market down 250 points, during the morning session?
Well, Pimm, I think there's panic selling, but there's also panic buying in a way. I think there's a lot of people in the markets right now who are trying to make sure they don't miss out on a rally. And that might actually be that retail investor that you were just referencing coming in, or the guy managing the money for that retail investor. I think there's a lot of shock weariness that's been setting in. You've seen the markets in an almost unbroken move off the late August lows without interruption. The markets have shrugged off the turbulence in North Africa that is very, very significant, that they've shrugged off what's been happening in Japan. Sure, the markets were off today, but they weren't off in ways that we've, been seeing in the past. A year ago during the Euro crisis, or certainly not in 2008 and early 2009. So the markets are showing a lot of resilience. My take is that that's very much flow driven, and there's been studies indicating that Bernanke has unleashed more than $3 trillion of capital flowing into equity markets. But I think one of the things to be very concerned about is that there's a lot of issues to be concerned about, deep structural issues. One of your colleagues was referencing housing earlier. Certainly that. There's several others we can discuss.
Dennis Hynes, I want to bring you in on this, and we're going to continue the conversation. But so who sells on a day like today? What causes the market to go down so quickly in that early morning session?
Yesterday's S&P market closed relatively firm. Things look pretty good. Overnight, of course, we had the terrible problem with the nuclear meltdown concerns. At the same time, the equity market, the S&P 500 futures, crashed overnight.
Those futures traders, those are the people that did it.
That wasn't the little people. I'm afraid it was some of the big people.
We're going to continue the conversation with Dennis. I want you to continue this thought about who was doing the selling, because when we see huge swings in the marketplace, somebody always calls and says it must be a program trade. It must be something that is put into a computer, that when the market hits a certain level or a stock hits a certain price, all of a sudden a trade is generated. And we've talked in the past about how much program trading is a factor in the market. What do you think caused this?
I'll make it a bit more simple than program trading. Program trading sounds a little complicated, but last week, market actually started to break down. At least our market started to break down. And there was a projection that you could make, and I don't believe in forecasting, but there was a pretty reasonable projection which said market's going to go to 1271 or 1250. Those are the two levels, and that really have to do with a rather simplified projection. So in fact, that was the thought process. We expected it to get there. Now, the reason we expect it to get there, again, I keep reminding you of the wonder of your Fibonacci study that you have within your computer systems. 1250 also happened to be the 50% retracement of the last rally phase from 1163 up to 1337. There were resting orders there, not program trades necessarily. Some of them are program trades, resting orders sitting there, and they were there. And as soon as the market traded down there, the market triggered buy signals. And those buys were in sufficient quantity to reverse the onslaught.
All right. Michael, you agree with that?
I very much agree with what Dennis just said. I think the Fibonacci's have been key in understanding where the support and resistance levels have been through this whole post-Lehman Brothers crisis phase. All right, so that we can even simplify it even more. That say that there's some magic number. It's not magic, but there's a specific number that people in the business are looking at, and they've got some calculation off of that says, all right, let's put some orders in here, guys. When it moves to this level, we want to do something. Right, and when it moves through those levels, then you have to watch out. But Dennis is absolutely spot on that we are in a very technically defined market, and as we've talked in the past, this is an environment we're dealing with an interim of a banking crisis where the fundamental compass is displaced. So technicals are taking up the sort of analytical focus because it's a very difficult market to ascertain what's really happening with global growth, what's happening here with the U.S. equities, with housing, with big macro issues.
All right, well, let's just trade off of what's happening with Japan, right?
Sure.
Because you've got the issue having to do with the nuclear reactors in Japan. You have the human catastrophe, which continues to unfold. Then you've got the trade issues. You've got the Bank of Japan adding huge amounts of liquidity to the system. Let's bring in the Federal Reserve from the United States today, coming out and saying, don't worry about it. Right. Interest rates, they're staying low. We said this before. We'll say it again. We want the economy to heal in the U.S. So does this mean that stocks are going to move higher, in your opinion?
I think there's going to be continued flows into equities, but it's done as much out of fear as it is out of greed, which I think is a very interesting dynamic.
Fear of what? Missing out on a rally?
No, missing out on a debasement of a currency. So, or protecting yourself from a debasement of a currency. So, right now we are in what you could call a print and pray approach that Bernanke is doing, which is a very dramatic experiment. I won't debate whether it's a good experiment, whether it's the right course of action or not, but it is an aggressive experiment. We don't know what the side effects are, but we do know that it is a very aggressive experiment. Japan may undertake this as well. As that happens, that's going to destabilize conventional financial analysis. So bond allocations, will probably continue to lose out to equities because they have an inherent hedge against that form of U.S. dollar debasement.
That's a very good point, Michael, right? Because we haven't really talked about it in terms of this being an experiment. Although, Dennis, I know that you in the past have said, look, just follow what Federal Reserve Chief Ben Bernanke says he's going to do and what he finally does, which is he's going to print money and he's going to try to inflate the economy.
Never fight the Fed. I think Michael makes some great points here. At some point in time, with the Fed, this is a Fed-driven equity market rally, has been, and Mr.
We got
Bernanke,
until June until the clock runs out.
Mr. Bernanke is out there saying it, and people look at him as the mentor for the world, so they follow him. But this is such incredible hubris, and the fact is, at some point, people are going to say the profligacy of the economy now needs to be addressed. And I think what Michael says is correct. Right now, people are afraid of missing that liquidity trade simply because Mr. Bernanke is telling you to do it. That's going to stop. Whether it stops soon or later, it's going to stop.
Why do I feel you're going to take us all to the woodshed eventually on this one, Dennis?
Well, what I do believe is that I think the issue here, let's move back to the here and now.
Right.
Because Mr. Bernanke is looking into the future, and I'm saying here and now is Japan. Japan, the causality here is let's see what happens tonight in Japan. If, in fact, we hear that the problems with the meltdown have, in fact, been dealt with, okay, then you'll see a follow-through rally, and we'll start to focus on Mr. Bernanke again. However, if it doesn't happen, what you'll see is a huge rally in the U.S. dollar, which is contrary to everything that Mr. Bernanke wants to do. He's trying to weaken it, trying to improve exports, okay, trying to get interest rates lower. But a huge rally in the dollar will get us to see the risk on trade go immediately off. We'll see gold plummet, which is the worst possible thing for everyone who, in fact, has purchased this market. So a rallying dollar, which is the last resort for safety. The Japanese yen is not there. The Swiss franc, which has been the historic, conventional place to go in safety, is having problems because it's in Europe, and we know what's happening in Europe.
All right, we're going to have to leave it there, gentlemen, but I can tell that there's going to be a lot more in this market. A lot more is going to happen before we get to June and the end of quantitative easing part 2. I want to thank you very much. Dennis Hynes, RW Pressprich, Michael Purves, BGC Financial, thank you very much for your contributions.